Hello, Accounting 230. It is Wednesday, February 22nd. The chapter is Chapter 8, and the subject is long-term assets and how to handle them. So with no further ado, let's get into our lesson here, accounting for long-term assets. Let me share the screen. Okay, let's have a little fun with this chapter here. I think you'll find some of this interesting. Dealing with long-term assets, non-current assets, assets that are going to be around for years to come, and we get to depreciate them. Compute the cost of a plant asset. Okay, a plant asset is tangible. Okay, it means you have to be able to touch it. It's there, it's physical, and it's used in the operation, and it's expected to provide future benefits, and typically called property, plant, and equipment. Okay, property, plant, and equipment, PPE. Plant assets. The cost of the asset might be just part of the total capitalization. For example, you buy a machine for $1 million, say, and that machine has to be transported across the country to your store or factory. The cost of that freight, moving that item across the country, that becomes part of the fixed asset cost, as does any insurance policy you may have bought to cover you while it's being delivered, okay? So you have the acquisition cost that you have to compute. And then we're going to allocate this over periods of time via depreciation expense. Cost determination. Like I said, acquisition cost is not just the purchase price. It takes into consideration all normal and reasonable expenditures necessary to get the asset in place and ready for intended use. Where I worked for many years, our factory was destroyed in an earthquake, the Whittier Narrows earthquake of 1987, and we had to build we went into a new factory, and it turned out we couldn't fit some of our new equipment in there. We had to knock a wall down. Well, the cost of knocking that wall down was capitalized as part of the asset. So all expenditures needed to prepare the asset for its intended use become part of the cost. And you have machinery and equipment, and they're giving you some examples here. You buy it, you have to pay to install it, insure it, move it across the country, taxes. At that point, all of that becomes part of the acquisition cost that we'll be able to depreciate. Buildings, you buy a building, well, there's going to be all kinds of legal fees. Real estate agents come into play, brokerage fees, taxes. Lawyers always get their share of the pie, title fees. All of that stuff becomes part of the acquisition cost of the building. What are land improvements? Okay. Land improvements are going to be depreciated, and they're defined as things that you add to the property after you've moved in, huh? A parking lot, a brand new parking lot, driveways, fences, walks, shrubs. It was a big display, lighting systems, perhaps. Those are called land improvements, and they too would be depreciated. Excuse me. Oh, pardon me. It has been cold in Santa Barbara lately. I'm freezing in my own house. Land improvements. Land. Land does not depreciate. There's an easy true false question I bet is on the test. Land is not depreciable. The purchase price of the land would be the amount that you paid per acre, real estate commissions, title fees, other surveying fees, property taxes, anything that you spent in due diligence getting that land ready, that's part of the land. So you get the idea. You have a purchase price of something, and then all of the other costs involved in getting that asset ready for use become part of the capitalized cost. Lump sum purchase, the total cost of a combined purchase of land and building is allocated based on their fair market values. In other words, you bought a land and building for say $1 million. Well, let's go through the example right in front of it. CarMax paid $90,000 cash to acquire a group of items. Land was appraised at 40 and a building for 60. The $90,000 cost will be allocated on the basis of the appraised values. So the appraised values were 40 and 60. That adds up to 100,000. So 40% of the land is going to 40% of that $100,000 is going to go to the land over here, and the balance will go to the building. They're based on their appraised values. Oh, the cost was 90,000, not 100. Okay, so my math was a little bit off. But you're going to debit the building for 54, the land for 36, cash. $90,000. Okay. Let's talk about some depreciation methods. One of which you should be very familiar with if you took Accounting 110. Compute and record depreciation using straight line. That's the most popular one, used by most companies in the world. Units of production could be another choice, and declining balance, and double declining balance. Don't forget that word double declining balance method. Depreciation, it's the process of allocating the cost of a plant asset to an expense in the subsequent years, benefiting from its use. You bought a machine for $60,000 and you're depreciating it over the years, and you're moving that acquisition cost eventually into the income statement. So depreciation expense is a legitimate corporate expense, and it's the type of expense that companies love because it reduces your net income, your taxable net income, without using cash. So depreciation is an important tool. Factors in computing depreciation. Well, we need to know some things. We need to know the cost of the unit. What was the acquisition cost on this machine? And we need to come up with what's called the salvage value or the residual value. And that's simply our best estimate of what this asset might be worth after it's fully depreciated. You bought a car for your sales manager, and she drives that thing up and down the coast of California, and she beats the heck out of that car. After 5 years, the car is fully depreciated, but it's pretty shot as a vehicle. You might estimate a salvage value of maybe $1,000. A junkyard will come in and take it off your hands for that. And we need to know the useful life. You have to estimate the useful life. How long is this asset going to provide benefits to us? So these are the three accounting terms: cost, salvage value, and the useful life. You have three methods that we're going to teach here, huh? And there are others. Straight line, units of production, and double declining balance. You notice I'm putting the word double in front of that for a reason. Double declining balance, okay? So here we have an asset that costs $10,000, and the salvage value we estimate to be $1,000. We will only depreciate the $9,000 under straight line accounting. Under two of these three methods of accounting, you do not depreciate the salvage value, okay? Straight line. This is pretty straightforward. Cost was $10,000. The salvage, the estimated value of what it's worth at the time of the discarding it or disposing of it, is $1,000. So we're going to depreciate 9,000 units, not 9,000 units, $9,000. The salvage value was 1. We're going to take that 9,000, divide it by 5, and we get $1,800 per year, or I guess $150 a month. So this company only writes journal entries once a year. So they're debiting depreciation expense and crediting an account called accumulated depreciation. Accumulated depreciation, in this case, machinery. Accumulated depreciation is a contra asset. As you know, all contra assets are married to somebody. The allowance for doubtful accounts, if you recall, was married to accounts receivable. Here we have an accumulated depreciation account, which has a normal credit balance, which makes it an outlier in the world of assets. So you are never going to credit the cost of the asset. You're never going to credit the asset itself, but its partner, its married partner, the accumulated depreciation. And what they're showing you here is that the depreciation expense under straight line is the same every period, every year. And while you're recording this accumulated depreciation, the net book value of the asset goes down every year until you're fully depreciated. Okay? Nothing too tough there, I don't think. And here's a look at the straight line depreciation schedule. How much are we depreciating? 9,000. You still start though with the book value of 10. You start with that 10,000 just to get it up there. And then every year we're taking 1/5 of 9,000 or 20%, 1,800 a year. That brings the accumulated depreciation to 18 and the net book value to 8,200. We repeat this all 5 years. We take 1,800, the accumulated depreciation is now 3,600, etc., till we get done. Notice at the end of this 5-year period, the accumulated depreciation equals $9,000. We're fully depreciated. Our net book value, which is the original cost minus the accumulated depreciation, is the book value of 1,000 or the salvage value. You can never depreciate below the salvage value. Book value, this little note here, net book value is the total cost minus the accumulated depreciation. Okay, here's another method now. Units of production. Units of production. This might be suitable for a car or a vehicle. You bought a car for your sales manager, huh? And you say to yourself, this car is going to last 250,000 miles. Under this method, you're not depreciating the cost. You are depreciating the miles, the cost per mile. So let's take a look at this. You have units of production method. Again, under this method, you do not depreciate the salvage value. All we're going to do is we're going to take the cost minus the salvage value and divide it by the units of production. It can be miles. It can be a machine that stamps out a product, and you say this machine will give us 1 million stamps over the years. So first step, take the net book value at the beginning, divided by the total units, and then you're going to do the depreciation expense. You're going to take the units, the actual units when they take place, and multiply them by the depreciation per unit. Let's see if this makes it a little easier. Assume that 7,000 units were inspected during the first year, okay? Here is our history. We start off with the book value with 10, minus the salvage value, which we do not depreciate. So that's 9,000, and they expect to inspect 36,000 shoes, okay? 36,000 pairs of shoes. 9,000 divided by the units of production, 36,000, gives you 2 bits a unit, 25 cents per shoe, 25 per pair of shoes inspected. So the depreciation expense is going to be 0.25, which we calculated here, times the 7,000 that they're telling us they actually expected that first year. And let's take a look at it. These are the units actually produced. And they're going to depreciate this thing up to 36,000. They can't go above 36. So again, you have the 10,000, the original cost of the asset, and the depreciable amount was based on the 9,000. 9 over 36,000 units gave us 25 cents per unit. So the first year, they inspected 7,000 pairs of shoes at 25 cents each. There's your depreciation expense. There's your accumulated depreciation after the first year. There is the net book value. And you repeat the process every year. 8,000 times 25, 9,000, etc. The accumulated depreciation keeps growing until it equals 9,000, and your salvage value is the net book value now of 1,000. Okay? Units produced and sold during the period. These are the actuals. So units of production, you get that cost per unit and multiply it by the actual units. Okay, double declining balance method, 3 steps, okay? Double declining balance. This method here is a little trickier. It ignores the salvage value. In other words, you don't subtract the salvage value as you do with the other methods, the units of production and straight line. So let's see what we have here. We have an item that costs $10,000 and the depreciable cost was 9. This is the basic information they've given us for all the methods. Straight line equals 100%. We're going to include the salvage value this time. Double declining balance. The reason we want to call it double declining balance is because it's always double whatever the straight line rate would be. On the test, you'll probably get a question along the lines of a company is depreciating their asset for 4 years on the straight line. Redo their calculation under this method, declining balance, and you'd have to say to yourself, let's see, 1 over 4 years, 1 over 4 is 25%. On the declining balance, 25 times 2 is 50, okay? Double declining balance rate is 2 times the straight line rate. Double declining balance times the beginning period book balance. Let's look at it more visually. Here we go. Put your thinking cap on. It's not that tough once you get the fundamentals down here. You'll be able to work at these. The book value is 10. That's the same in all methods. Under double declining balance, we have to figure out what the straight line percentage would be. 1, 2, 3, 4, 5. 5 years. 1 year divided by 5 is 20%. Huh? Under straight line, you'd be depreciating the same amount, 20% every year. Double declining balance, you double that 20% and you get 40%. Okay? So let's look at this. Book value was 10 times 40% gives you $4,000 of depreciation expense in the first year. Accumulated depreciation goes up 4, and your book balance is 6. Now, we're going to take that 6,000 and multiply it by 40% again. This time you get 2,400. Your accumulated depreciation has grown to 6,400. The net book value is down to 3,600. What do you notice about this method? It's top loaded. The highest years of depreciation are going to be in the first couple of years. So this is a method companies might choose if they want to scoff up as much depreciation expense in the next couple of years, knowing that the number is going to be lower in the future. There could be strategic reasons companies choose these methods. And here we're just comparing the methods. They all depreciate the same amount after 5 years, but straight line, huh? 1,800 a year, nice and easy. Units of production. Here it varies based on the actual units, the actual shoes inspected. And double declining balance, you're going to start with a big number and work your way down to a little number. And here they're saying that straight line is used by 85% of the world. That's I believe it, huh? Declining balance is 4%, and units of production is 5. So that's what 85 plus 9. That's 94%. There are other methods. My favorite is one called sum of the year's digits, which we'll not talk about. Depreciation for tax accounting. Most companies use the modified recovery system. It provides for rapid write-off of an asset's cost in order to stimulate new investment. That's the theory anyway. Explain depreciation for partial years and changes in estimates. Good gosh. But take a look. Partial year depreciation. When a plant asset is bought during the year, the depreciation is calculated just for that fraction of the year that it was owned. So here they're giving us the same information again, same information, only this time, assume our machinery was purchased on October 1st. Let's calculate using straight line. Well, we know we take 10,000 minus the salvage value. That was 9,000. We divide by 5, and you should recall that gave us $1,800 a year. $1,800 a year. But we only had this asset for 3 months, huh? October, November, December. 1/4 of a year, if you will. So we're going to take 3 over 12 and take 1/4 of that 1,800, and that becomes your depreciation expense. Changes in the estimates. This can be a little tricky sometimes, so let's take a look at it. Changes in estimates. You may have a change in the salvage value, the predicted useful life. Depreciation, remember, is an estimate, and you may be forced to change that estimate if the machine is not doing what you expected it to do, or if the machine is performing above what you thought it would do. You can go in there and change the depreciation base. Over the life of the asset, new information may come to light, indicates the original estimates were inaccurate. Typically, what we're talking about is a machine that maybe is going to last more years than you thought or fewer years. Changes in estimate for depreciation. Let's look at our machinery and assume at the beginning of the asset's 3rd year, the book value was 6,400. That's the book value after the 3rd year, 10,000 less 3,600 using depreciation expense at the beginning of the 3rd year. Remember, it was $1,800 a year. For 2 years now, 3,600. At that time, it's determined the machine will have a remaining useful life of 4 years, and an estimated salvage value will be revised down from 1,000 to 400. So what are they talking about? We originally had a machine that we were depreciating for 5 years. It's been depreciated 2 years, but they're saying the remaining useful life is going to be 4. So we have to figure out what the depreciation would be, assuming that the machine's going to last a couple of years longer. So our little formula here, book value minus that salvage value again, the new salvage value. This is the book value at the time of the change. We're simply going to divide that by 4, and now our new depreciation per year is 1,500. 1,500, okay? Take the book value as it stands after 2 years. Revised salvage value is now 400. We divide that by the remaining 4 years, okay? Asset impairment. Ooh. Permanent decline in the fair value of an asset requires writing the asset down to its fair value, which could be 0, huh? Asset impairment is the process of journalizing this decline. You bought a machine for $50,000 to make a product. Unfortunately, the product it was making was VCRs. Nobody buys VCRs anymore. You have a machine that can really make them, though, except nobody's buying them. That machine is impaired. It's not going to get you any future benefits. So you simply have to record the loss. We're going to debit a loss here. They're calling it impairment loss. I've seen different descriptions. And credit accumulated depreciation equipment. You have now reduced the book value of that asset down to where it should be, okay, based on new information. Distinguish between revenue and capital expenditures and account for them. Revenue and capital expenditures. Capital expenditures are those that are recorded on the balance sheet, and the revenues and expenses go to the income statement. And there are simple rules that we need to have in our mind. Additional expenditures. Revenue expenditures. I wish they would use the term revenue and expenses. Revenue and expenditures do not materially increase the plant's asset life or capabilities. It's recorded as an expense in the current period on the income statement. What are we talking about? Your company owns a fleet of trucks. Own one truck. I'm thinking big, but we don't have to do that. You have a company truck, very valuable piece of equipment. Every 2 months, you change the air filter and the oil filter in that car and tune it up in that truck. That is not increasing the value or life of the car. It's just normal maintenance expense. If we were in the classroom, you would see above you the HVAC pipes, for the air conditioning and things. When we bought that and installed it, that was a capital expenditure. It goes on the balance sheet. But once a year, one of the custodians has to take a ladder, crawl up there and change the filter. That would be just an expense, okay? Capital expenditures, they provide benefits for longer than the current period, and it's an addition to the balance sheet, an asset account on the balance sheet. So if it's just a normal repair, that was what the book is calling a revenue expenditure. If it's something else more complicated and expensive, probably a capital expenditure. You have a car and you tune it up every 6 months, I don't know. And that tune-up is just regular maintenance. That's revenue. But then you go out and you want to really soup this thing up. You replace the engine. You put in a big, big 350 engine with a bunch of horsepower. Now you have increased what that machine can do. It's probably its life. That would be a capital expenditure. And here's a good way to say it right here. Ordinary repairs, those are expenses. We don't depreciate them. We record them as they happen. They're a normal course of business. Ordinary expenses, maintain the asset, doesn't increase anything. The betterments and extraordinary repairs, that's a different thing. Major overhauls or partial replacements extends the life beyond the current estimate. Well, there you have a balance sheet item called a capital expenditure. And the word expenditure just means spending, by the way, spending. Ordinary repair. You went out and you changed the spark plugs in your car. That's a repairs expense. Normal maintenance. You debit 500 repairs expense, credit cash. We're done. You went out and, like I said, you put a brand new 427 engine into your Volkswagen. Well, that is certainly an improvement which would go on the balance sheet. Account for plant disposal through discarding or selling an asset. Well, you're not in the business of buying and selling assets. So that's kind of an unusual thing, but it happens, especially as the asset gets older and you look to get rid of it. Disposal of plant assets. Update the depreciation to the current date. Okay, we do that every month, right? And you journalize the disposal. You're going to record the cash. You're going to debit cash. You're going to debit accumulated depreciation. You're going to debit cash, debit accumulated depreciation, credit the original cost of the asset. Can you remember those three things? You debit the cash you receive, you debit the accumulated depreciation, which has a credit balance. We have to take that down to zero. That leaves the original cost of the asset. That has to come out with a credit, and any difference becomes a gain or a loss on the disposal or sale of the asset. Simply, if the cash is more than the book value, you have a gain. If it's less than the book value, you have a loss. Recording cash, you debit the cash, you debit accumulated depreciation. Automatically debit that, those two guys. Credit the asset cost. Automatically do that. Don't even have to think. And then you'll be able to figure out the gain or the loss. Here we go. A machine costing $9,000 with accumulated depreciation. Let me read this thing. A machine costing $9,000 with accumulated depreciation of $9,000 at December 31st. It was discarded in June. The company is depreciating the equipment using straight line method over zero salvage value. So they're getting rid of a machine with accumulated depreciation of $9,000. You are going to debit accumulated depreciation and credit the machinery. They're teaching this in two-line entries, I guess, which I don't think is a good way to go. This is better. Assets not fully depreciated, but we're getting rid of them. Equipment costing $8,000 with accumulated depreciation of $6,000 was discarded. Well, we just had to throw it away. When we say discarding it, we made no cash. We just had to throw it out. So remember our journal entry. We automatically, the company is using straight line over 8 years. They have to, in this case here, since they're getting rid of the machine at the end of June, they have to record another half year of depreciation. Remember our number there, 500. So now we're ready to discard. We don't have any cash to debit, but you debit the accumulated depreciation. You credit the original cost of the asset. The difference results in a $1,500 loss. Okay. Selling plant assets at book value. Well, that's nice if you can do that, but let's see. BTO sells equipment that originally cost 16 and has accumulated depreciation of 4 at the end of the year. They use straight line depreciation of $4,000 a year. So again, I'd like you to think of these two entries as just one journal entry, to be honest with you. What do we know we debit automatically? We debit the cash. We debit the accumulated depreciation. We credit the original cost of the equipment. And in this case, we're done because the book value was 16 and we got 16,000 for it. No gain or loss. Now we're selling it above the book value. Again, we have a book value of $4,000. 16,000 minus 12, that's our book value. But we found a sucker to give us 7,000 for the machine, huh? So let's take a look. Again, this should be one journal entry, not two. I don't like this. But we know we have to get the depreciation expense up to where it needs to be at the end of March 31st. And there we go. Depreciation expense, accumulated depreciation. Now, here's how the journal entry should look. Now, they're doing it my way. We know we debit cash. We know we debit the accumulated depreciation. And we know we credit the original equipment. You have 20,000 here, 7 and 13. You only have 16 here. Therefore, you have a gain of 4,000. Okay. Book value minus the consideration is your gain or loss. Let's see something here. So here we had a gain of 4,000. Now we're selling it for only 2,500, huh? 2,500. The book value at the end of the year was $4,000. 16 minus 12. We have to record another 3 months of depreciation since we're getting rid of the asset at the end of March. We debit depreciation expense. We credit accumulated depreciation. And here's your journal entry in good form. You debit cash, debit accumulated depreciation, you credit equipment. Well, we have 16,000 on the credit side, but we only have 2,500 plus 13,000 on the debit side. That's a loss of $500, okay? Account for natural resources and their depletion. What we're going to learn here is that you depreciate tangible physical assets that you can see, like a building or cars, vehicles, equipment. You depreciate the tangible, you deplete natural resources. It's not called depreciation expense now. It's called depletion. We're using up a natural resource like an oil well or a forest. My daily soda here, I just depleted this. I drank it. Natural resources. The total cost is charged to depletion expense over periods benefited. What are we talking about? We're talking about things extracted from the natural environment and reported at cost less accumulated depletion. So just like they have accumulated depreciation, they're telling us about accumulated depletion. Oil, coal, gold, a mineral deposit with an estimated 250,000 tons of available ores purchased for $500,000. We expect zero salvage value. We're just going to dig this mine out, and when we're done, we walk away. Well, the first thing we have to do is figure out the depletion per unit. We paid $500,000. There's no salvage value, which makes it easy. So 500,000 divided by 250 is $2 per ton is going to be our depletion expense. You notice this is the same exact thing as the units of production method we learned on plant assets. So here we go. Depletion expense. Depletion per unit is $2. How much did they actually extract and sell? 85,000 times 2, 170. There's your depletion expense. Depletion expense would be, they went through this thing and they came up with 170 in expense, and they're crediting accumulated depletion. That's an easy mistake to say, huh? Accumulated depletion in this case. And it's going to look like this on the balance sheet, just like it looks for fixed assets. You're going to see the original fixed asset, original cost, just like you see it here for the mineral deposit, less the accumulated depletion, and that gets you down to a net book value of 330. Okay. Here's your journal entry. Depletion expense 140, or inventory, we debit and we credit depreciation and inventory of mineral deposit. Depreciation expense when some ore remains unsold at year end. Okay. Plant assets tied into extracting. Yike. Specialized plant assets may be required to extract the natural resource. If you have an oil well, you're going to have a very expensive bunch of equipment there. You're going to have an oil derrick, an oil drill that goes way down into the earth, pulling out the oil. Specialized plant assets may be needed to extract natural resources. These assets are recorded in a separate account and depreciated. Okay. The only thing you deplete is the natural resources itself. Any assets used to get the depletion done, those are just regular fixed assets. Intangible assets. Whoa. Remember I said we depreciate physical assets like plant assets? We deplete natural resources. Now we got another word, amortize. We're going to amortize intangible asset. An intangible asset is an asset you can't see. It has no physical quality. You can't see it. You can't point to it and say, there it is. We're talking intellectual property, really, okay? Intangible assets. Non-current, that's important. They're non-current without physical substance. The useful life can be difficult to determine and usually acquired for operational purposes, often provides exclusive rights and privileges. Intangible assets. Look at them. Here are some. They are recorded at cost using the purchase price and any legal and filing fees involved. Huh? You bought a patent from an inventor and he sold his patent to you for $900,000, and there was $100,000 worth of legal fees you had to pay, and it all becomes the price of the patent that you are going to amortize. A patent is a federal, how do I want to say this? A patent is issued by the United States federal government to an inventor. You invent a product, you and you alone are allowed to benefit from them. You are allowed to start producing and selling that product if you wish, marketing it if you wish, and you get all the profits for you. Or you may decide to sell it. An inventor may come up with a great machine, but he is not in the position to market or mass produce it. So he calls up a big company and said, would you guys be interested in this? And fortunately, yeah. Patent, copyright, that is printed material. You sell a novel, no one else can publish that novel and make money from it for a number of years. Patents are 20 years, copyrights go on longer. Franchises and licenses, trademarks, the McDonald's Golden Arch, huh? McNugget, a trade name. Goodwill, which we'll learn about, I guess, at the end of this chapter here. It's the amount you pay in excess of the fair market value of the company, and all kinds of things. There are other intangibles. Is that all we're going to talk about with intangibles? That's everything? I was expecting to see some more. But let me talk about them a little bit more. Patents go for 20 years, okay? an inventor gets a patent from the government. Thomas Edison got a patent for the electric light bulb. Boy, that's a good patent to own, huh? Thomas Edison got that patent, but he could not put that patent on his financial statements. The person who invented the patent, they don't get to put the patent on their financial statements because they were allowed to deduct as an expense all of the costs involved in developing the patent. The patent is only on the purchaser of the patent. Thomas Edison sold the patent to General Electric. General Electric now has a $1 million patent that they can amortize, okay? Oh, wow, we got a metric here. Compute total asset turnover, and let's analyze the company's use of assets. Here's a formula. Got to know it for the test, huh? Total asset turnover, net sales divided by average total assets. That would be the balance of the assets at January 1st plus the asset balance at the end of the year averaged out, divided by 2. The asset turnover provides information about a company's efficiency in using its assets. So let's see here. Asset turnover here for Starbucks has been in the 160 area, huh? 165, 160. It seems to be going down a little bit. Jack in the Box is a little bit lower, but a little more consistent, 120. Okay. The turnover, the higher the number, the better. The total asset turnover for Starbucks is 1.56, a little better than Jack in the Box at 1.21. And that does it for this lecture. So, anybody have questions? Okay, nobody has questions. Hey, good luck with this material. I don't think this chapter is terribly difficult. You do the homework and make a conscious effort to write a good summary, and you should be all right. Don't forget, we have a lot of tutoring hours available. Check on the module to see when I'm available for tutoring, or Connor. We finally have another tutor, Connor, a fellow student of yours who's doing a good job. Okay, we will say goodbye until next week. Take it easy.